Transitory inflation. The post-economic downturn reflation period is inherently temporary, as increasing market interest rates could curb investment and consumption, and unchecked price rises could inject uncertainty into the economy. From November 2020, prices began shifting from deflation to controlled inflation. Yet, concerns arose about escalating inflation, as unchecked inflation reduces purchasing power, affecting consumers and leading to decreased spending. Historically, the Fed preemptively combated inflation by raising interest rates, leading to investor fears that an aggressive Fed response to inflation could dampen financial market buoyancy and economic growth. By January 2021, the 10-year inflation expectation in the bond market exceeded the Fed's 2% target, indicating bond investors expected prices to rise annually by 2% or more over the next decade. This significant rise from March 2020's 0.5% reflected increased market anxiety about inflation. By March 2021, actual PCE inflation also topped 2%. While the Fed's average inflation targeting, 8, policy allows temporary overshooting, core PCE inflation reaching 3.12% in April intensified concerns that the Fed might tighten monetary policy. The inflation rise in the early 2020s can be attributed to massive liquidity, import prices linked to the dollar's value, volatile energy prices, and irreversible wage increases. Factors contributing to the inflationary period included economic overheating due to rapid recovery, a surge in consumer demand, the Fed's ongoing quantitative easing, and the U.S. government's assertive fiscal policies. Supply chain disruptions and dollar depreciation also exacerbated inflation. The Federal Reserve considered this inflation surge temporary, underpinned by the base effect from low 2020 rates, a finite surge in pent-up demand, optimistic supply chain recovery views, and a decade-long history of inflation not causing overheating. Additionally, the Fed believed that the slower recovery pace in emerging countries could mitigate inflationary pressures. Treasury Secretary Janet Yellen assured that they possessed the tools to manage inflation effectively. Despite the Fed's assurances, rising long-term interest rates in the bond market indicated investor anxiety about potential interest rate hikes. These concerns were heightened by the uptick in short-term rates around June 2021, suggesting impending Fed action. Investors, wary of the high debt levels accumulated by U.S. companies and potential impacts of interest rate hikes, sold off bonds preemptively. Investors also feared stagflation, a condition of simultaneous inflation and recession. Indicators like the Purchasing Managers' Index and the Weekly Economic Index showed slowing economic growth coupled with rising inflation rates, signaling the complexity of the economic recovery phase. The stock market, in contrast, continued its ascent, buoyed by investor confidence in the Federal Reserve's commitment to easy monetary policy and the belief in a Fed put, a notion that the Fed would prevent market downturns. This confidence led to a bullish trend in stocks and a lack of in-depth price forecast analysis among investors, indicating a market driven more by sentiment than fundamentals. The stock market's continued rise, even amid inflation concerns and economic slowdown indicators, demonstrated the unique dynamics and investor confidence during this period of recovery and uncertainty. Delicate balance between inflation control and growth sustenance. As global inflation began rising, foreign central banks in countries like Mexico, Brazil, Russia, and Norway initiated interest rate hikes by mid-2021. This global response to inflationary pressures highlighted the growing concern among financial institutions worldwide. In this milieu, the Federal Reserve maintained that inflation was temporary, possibly as a strategic decision to balance inflation control and economic growth sustainment. The stock market bubble's growth and rising inflation posed a significant challenge to the Federal Reserve, which sought to reduce quantitative easing while maintaining growth momentum. By June 2021, the Federal Reserve subtly indicated a move towards some austerity, while still insisting on inflation's temporary nature. Market reactions were mirrored in the 10-year Treasury bond interest rates behavior, reflecting anticipation of growth in the first half of 2021 and close observation of the Federal Reserve's strategies in the latter half. During this period, the Federal Reserve raised the reverse repo rate and the interest on excess reserves rate. These moves, while technical, signaled a cautious tightening stance. Additionally, the Federal Reserve announced its intention to sell the relatively small amount of corporate bonds purchased under the secondary market corporate credit facility, signifying a potential shift in its approach to managing market liquidity. The Federal Reserve's outlook on future interest rates was more concretely indicated in the Summary of Economic Projections, SEP, particularly through the dot plot. A noticeable shift was observed in the dot plot, with an upward adjustment in the interest rate forecasts for the future, hinting at an anticipatory rise in interest rates. This adjustment signaled a possible earlier start to tapering and subsequent rate hikes. As the Federal Reserve hinted at tightening monetary policy, financial markets reacted with sensitivity to the potential of impending interest rate increases. The consensus among market predictions and expert analyses was that tapering would likely commence in 2022, reducing the scale of the Federal Reserve's quantitative easing program. This anticipation was underpinned by the continued rise of housing prices in the United States, leading to concerns of overheating in the housing market. The consensus was growing that the Federal Reserve no longer needed to support the housing market through its mortgage-backed securities purchases. Despite the subtle indications of tightening, the Federal Reserve continued to emphasize dovish policy messages, asserting that monetary policy decisions would be based on tangible economic results and not temporary fluctuations. It pledged to continue quantitative easing until substantial progress was made toward its dual goals of maximum employment and 2% inflation rate. Furthermore, the Federal Reserve clarified that the criteria for tapering and raising interest rates were distinct, with more stringent standards for rate hikes. The financial markets reacted to the Federal Reserve's balancing act between inflation concerns and growth sustenance. The bond market's initial reaction to the anticipation of Federal Reserve tightening was an increase in market interest rates. However, subsequent Federal Reserve communications emphasizing temporary inflation and a focus on maximum employment led to a stabilization of rates. In the stock market, investor confidence in the Federal Reserve's commitment to market stability continued to drive stock prices upwards. The financial markets were highly sensitive to any news that might suggest future monetary policy direction, leading to paradoxical reactions to economic news based on the perceived implications for fiscal and monetary support. This delicate balance between addressing inflation and sustaining growth remained a central theme in the Federal Reserve's approach and significantly influenced market dynamics during this period.